Let's start with a number that might make you a little uncomfortable. Over the last decade, a staggering 80 to 90% of professional fund managers failed to beat the S&P 500. Let that sink in. The vast majority of the so-called experts, with all their research and teams of analysts, couldn't do better than simply buying the entire market. It's a statistic that's been the bedrock of the modern investing gospel. Buy index funds, be lazy, and you'll win. And if you're like millions of people, you've built your entire financial future on this idea. Your 401k, your IRA, it's all parked in funds that track the S&P 500 or the total stock market. It feels safe. It feels smart. But what if I told you that this lazy strategy is building a risk into your portfolio that you can't even see? That the very thing you think is protecting you could be setting you up for a devastating surprise. The truth is, your index funds are secretly riskier than you've been led to believe, and today, we're going to pull back the curtain. The problem isn't that index funds are a bad idea. The problem is that they've become the only idea for too many people. We've been sold a story of set it and forget it simplicity, and in the process, we've stopped asking critical questions. We've confused widespread popularity with safety. But in the world of finance, whenever a strategy becomes this ubiquitous, it creates its own unique set of dangers. You need this information because your financial freedom is on the line. Blindly trusting a strategy without understanding its hidden flaws is the opposite of being a smart investor. It's being a complacent one. So, let's break down exactly why your lazy portfolio might be keeping you up at night in a few years. First, and this is the big one, extreme concentration risk. When you buy an S&P 500 index fund, you might think you're buying 500 equal pieces of America's top companies. But that's not how it works. These funds are market cap weighted. That means the companies with the biggest stock market valuations take up the most space in the fund. And right now, the top-heavy nature is absolutely staggering. Think about this. The Magnificent Seven, companies like Apple, Microsoft, Nvidia, Amazon, now make up over 30% of the entire S&P 500. Let me say that again. 7 companies out of 500 account for almost a third of your index fund. So when you think you're diversified across the entire US economy, you're actually making a massive, concentrated bet on the performance of a handful of tech stocks. If they soar, your fund soars. But if just 1 or 2 of them stumble badly, the entire index and your retirement account feels the pain disproportionately. This isn't diversification, it's a disguised bet on a very narrow sector. Second, we have the illusion of safety in crowds. There's a psychological phenomenon where we feel safer doing what everyone else is doing. But in investing, the crowd is often wrong at the most critical moments. Index investing is now the dominant strategy. Trillions of dollars are pouring into these funds automatically, every single month, regardless of a company's price or valuation. This creates a dangerous feedback loop. Money flows into the index, which forces the fund to buy more shares of the top companies, which drives their prices up even higher, which makes them an even bigger part of the index, which attracts more money. It becomes a self-fulfilling prophecy that detaches stock prices from their underlying business value. What happens when the music stops? When the flows reverse? The very mechanism that drove prices up can accelerate a downturn as automated selling takes over. You're not just invested in companies, you're invested in the momentum of the crowd itself. Point number 3, you are completely exposed to sector-specific bubbles. Because your index fund is so weighted towards the biggest companies, and those companies are overwhelmingly in technology, your portfolio is dangerously tied to the fate of a single sector. Let's take a quick history lesson. Remember the dot-com bubble? In March of 2000, technology stocks made up a massive 35% of the S&P 500. When that bubble popped, the index lost nearly 50% of its value and took over 7 years to recover to its previous high. Now look at today. Information technology is back to a similar dominant weighting. You are, in effect, holding a portfolio that looks eerily similar to the one that got crushed at the turn of the millennium. The lazy investor isn't avoiding this risk, they are driving right towards it with their eyes wide shut. Fourth, and this is a subtle one, you've surrendered your most powerful tool, your vote. When you own an index fund, you technically own shares in all those companies. But the fund manager, like BlackRock or Vanguard, votes your shares on corporate matters like executive pay, board appointments, and environmental policies. This has consolidated an immense amount of power into the hands of just a few massive financial institutions. Your voice as a shareholder is silenced. This might not seem like a big deal until you realize that corporate governance, how well a company is run, is a critical component of long-term value. When three giant firms control the votes for a huge chunk of corporate America, it can stifle competition and entrench underperforming management. You've outsourced your ownership, and with it, your power to influence the companies you supposedly own. Fifth, you are guaranteed to buy overvalued companies. Think about the process. An index fund must buy a stock when it enters the index, and it must sell when it leaves. It does this blindly, with no regard for price. When a company like Tesla was added to the S&P 500, index funds were forced to buy billions of dollars worth of its stock at that very moment, regardless of whether it was trading at a sensible valuation. Conversely, when a company is kicked out of the index, it's forced to sell at what is likely a depressed price. An active manager can choose to avoid an overpriced stock or buy a beaten down one. The lazy investor, through their index fund, is programmed to buy high and sell low in these specific predictable instances. And finally, let's talk about the myth of the average return. We always see charts showing the steady upward climb of the S&P 500. But that smooth line hides the brutal reality of volatility and sequence of returns risk. The average annual return might be, say, 10%. But that's just a math calculation. Your lived experience is different. If you need to retire and start drawing down your savings in a year like 2008 or 2009, a 50% drop in your portfolio isn't an average. It's a catastrophe from which you may not recover. The lazy investor strategy assumes you have a 40-year time horizon and the stomach to never, ever panic sell. But life happens. You might need that money sooner. By ignoring the potential for deep, prolonged drawdowns, you're taking on a massive timing risk that the cheerful historical charts completely gloss over. So what's the solution? Am I telling you to sell all your index funds and become a day trader? Absolutely not. The core principles of broad diversification and low costs are still sound. But the intelligent investor, the one who truly wants to build lasting wealth, cannot be lazy. You must be engaged. This might mean complementing your core index holdings with actively managed funds in specific areas, or adding international and emerging market funds to break your dependence on the US mega caps. It might mean allocating a small portion to assets that aren't correlated with the stock market at all. Most importantly, it means understanding what you truly own and the hidden concentrations and risks within it. Your financial future is too important to be put on autopilot without ever checking the instruments. Don't just be a passenger in your own financial life. Take the controls. If you're ready to move beyond the simplistic advice and learn the strategies that can actually build and protect your wealth in today's complex market, you need to be part of a community that thinks like you do. Hit that subscribe button and ring the notification bell, because we're here to give you the unvarnished truth every single week.